Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly video with our friends at Strategas. Today, we are lucky enough to be joined by Chief Economist Don Rissmiller. Don, how are you doing today?
Very good, Ross. Good to talk with you.
Yeah, great to have you, and very fortuitous. We are recording on a Thursday, a couple hours after a very hot inflation print, one of the highest readings in 40 years. I'm going to turn it over to you. What are your big takeaways from this? What are the implications for the Fed? What are you watching closely from here?
Well, it's good to be here. Good to talk about this. So it's an important release. It's an important release because we are seeing some upside surprises continuing into 2022. So if there was any idea that inflation was going to go away on its own, which was the sentiment last year, I think we're now at a point where it's going to take some action. It's probably going to take central bank action, and it's probably going to take action in the private sector to bring this down. So we are seeing the inflation numbers broaden out. We have seen apparel move. We are seeing rents move. And so this is in addition to some of the components like used cars, which really could be dismissed as one-offs in prior reports. Here we're getting a broader inflation story. It's goods and services. And that means we're at the point where you're going to have to inflect on monetary policy. So the Fed here is still doing quantitative easing. That's strange with 7.5% inflation and a 4% unemployment rate. They have committed to stopping that policy. We are tapering QE, but we are going to have to pivot pretty quickly to rate hikes. And I think you're probably going to have to see a sequence of rate hikes, March, May, June, before the Fed is going to get into some more regular policy where they hike once a quarter. But then that's going to take us out to 2023. There's a lot of work to do here. It's probably going to invite some quantitative tightening as well to undo the quantitative easing that is still happening. So an important report because it solidifies this idea that the Fed is behind the curve, is going to have to inflect in March, and that inflection will probably include rate hikes and quantitative tightening as we go forward.
That's great context. And you kind of mentioned it looks a little stickier 2023. You're talking about things like rents, which tend to be stickier. Wages are also a problem here. Wage growth has been very strong. Wage inflation is a big problem for businesses. What are you seeing on that front, and what does that mean for your inflation outlook going forward?
Yeah, it really is central to the outlook. So if we look at the weights in the inflation metrics, you have core goods ex food and energy, which are about 20% of the number, core services, which are about 60% of the number, and then food and energy, which are the other 20%. Now, food and energy get taken out for most policy decisions because they're known to be choppy. But what's risen in the past year, really surged, is core goods. And now you're starting to get core services moving higher. So what we really need to see is core goods level out to offset wage gains and core service gains going forward. That's where the stickiness is coming from. Wage gains matter because one of the inputs into service production is the labor input. And so if you're anchoring that large share of the inflation number up around 4%, if we use something like the employment cost index, you're going to have to get core goods to level out to bring those numbers down. That's a reasonable bet. There are good reasons to think core goods level out, but it just makes that all the more urgent when we see these numbers getting to wages and those metrics.
And that's a problem for businesses, right? You were mentioning earlier, particularly small businesses, the confidence there, the optimism there has really started to wane, which has a lot of flow-through effects for the rest of the economy. Could you talk about that a bit?
Sure. We also saw the NFIB Small Business Optimism Index this week, and that weakened. And we see evidence that businesses are having trouble attracting workers. They're trying to pay higher wages. Even that may not be enough, so they have to pay even higher wages. They're trying to find the right skill set. That remains a challenge. So business confidence has been okay over the past year, partly because for large businesses, we've had very good profits. And we have good profits. Large business confidence metrics look pretty good. Small business confidence is where we're starting to see the break here. And so if there was any fiscal stimulus, that's now running out. and you're worried about inflation, you're worried about wage gains on the cost side, and that is starting to bite based on that NFIB data.
Okay, let's end here. You kind of laid out what your expectations for the path of rate hikes are. There is a move, the Fed typically hikes in 25 basis point or 0.25% increments. They could hike in 50 basis point increments earlier in the cycle. It doesn't sound like it's your base case, but what do you think the odds of a 50 basis point rate hike are at the March meeting?
So we'll get some more data before then, but what the market's saying is that's a coin flip at this point. In other words, I think the logic for a 50 basis point hike is there. It's just it hasn't been the Fed's preference because they have been moving slowly. They are not moving very quickly to end QE. So to do a 50 basis point hike would be a very aggressive pivot here. Maybe they could have ended bond purchases earlier and that would have given them some more flexibility. But that type of really aggressive policy pivot, I think, is still not the way they'd prefer to act. But the data's there where you could see a dissent. You could see some votes for a 50 basis point hike as we get to the meeting, assuming things in March look like they do today.
Well, if there was any doubt about it, we're certainly entering a new regime for monetary policy and inflation. Don, thank you so much for your time today. I'm sure we'll talk again soon as this remains an important story for markets. So thanks so much for the time.
Thanks a lot, Ross.